Hello guys, welcome back to the channel, and today we have a fundamental analysis video for you guys where we'll try to look at the balance sheets and the income statements and try to spot some potential multi-baggers from micro-cap stocks. So what are micro-cap stocks? So micro-cap stocks isn't really a very formal term as such. So you know small cap stocks, right? So small cap stocks are those which are the stocks with market capitalizations less than 5,000 crores. So these stocks we are going to see right now are much lesser than, have market capitalizations much lesser than 5,000 crores, in hundreds of crores itself. Maybe one of these is about 1200, but most of these are in hundreds only. So these are very small firms as of yet and very small stocks, and I've made sure that there's not much market manipulation going on in any of these, and let's just look at the stocks and the firms and see if they could turn into multi-baggers in the next few years or so. So we'll go over with the first stock. So the first stock, again, before we start off, disclaimer: this is not financial advice and is for educational purposes only, and please consult with your financial advisors before taking any decisions. So remember that these whatever stocks we are going to analyze are very risky because they are multi-baggers indeed. So when there is huge reward, there also comes huge risks with it. So always make sure you only invest what you can afford to lose, and make sure you follow risk management as well. So the first stock we look at is Mazda Limited. So it is in the pump and compressors manufacturing sector, and so this is the overview of it. It is located in Gujarat and is a pump and compressor manufacturing industry. So over the last 5 years, market share has increased from 0.26% to 0.34%. That doesn't really seem like a lot, but when you see market share is the share throughout the country, right? So even a 0.1% increase is a major chunk. Not really a major chunk, but it is a significant increase for a company of this size. So over the last 5 years, revenues have grown at 8.75% versus industry average of 2.84%. So this is what the significance of even this small share increase in market share has led to some tremendous increase in revenues. So, and the debt to equity ratio is just 1.64% versus the industry average of 32.94. So you can see the company operates on such less debt, which obviously reduces the risks of the company significantly. So this is another very important point to keep in mind about this company. Now looking at the revenues, you can see there is a steady increase. There was a small hiccup in financial year 18, which was mainly due to a specific event, firm specific event, one of their factories closing down or something on those lines. So it is not something to be worried much about, but you can see there is a steady increase from 115 crores to 181 crores in the latest financial year 20. So, and this financial year 20 was, as you know, with the country suffering from the pandemic. So this was a good result indeed. The EPS also has been steadily increasing, and another very crucial point to keep in mind about this is the DPS, which is the dividend per share. So they have been announcing steady dividends. The current market price of the share, if we look at Mazda Limited, is around 670. So on a share which is worth 670, if they're giving 10 rupees, that means that is almost equal to less than 1%, more than 1%, right? So almost 2%. So it is quite a significant dividend payout for a company which is still in its expansion phase. So their payout ratio has remained constant around that 0.25 to 0.3 mark. So what is the payout ratio? Payout ratio is out of your total income, out of your total profits which you're getting, how much what factor of that are you giving to your shareholders as the dividend? So 0.25 means if they made 100 rupees, they gave 25 rupees as dividend to all shareholders. So you can see that the payout ratio is being maintained constant. So as the income of the company keeps increasing, you can expect a linear increase in the dividends as well. Now if we look at the assets here, total assets have been increasing. So this means company is making investments. Now if I divide this into current assets and non-current assets. So what are current assets and non-current assets? Current assets are basically your liquid assets like your cash or any other form of cash which can be liquidated quickly, and non-current assets means nothing but fixed assets like your machinery or factories. So you can see that this investment, this total investment, total assets which have grown is mainly in the non-current assets, that is the fixed assets. So what does this mean? The company is acquiring fixed assets means it is trying to expand its business. So again, this is a good sign, and the current assets are decreasing. That means their cash is decreasing, so they're spending this to acquire certain fixed assets. So you can see that the company is still in expansion phase and still holds huge potential. So that's it. And the next company is Kingfish Science and Technology. It's in the commodity chemical sector. Now let's look at the company overview. So this is a chemicals company. So it is one of the best stocks here. And with the onset of current COVID-19 pandemic, the company is producing face masks which comply with global specification. Now I don't need to explain to you how crucial this point is and how much this could help with the revenues of the company, the face mask production. And it may also become the export hub for the company, even as several tie-ups with German car manufacturers are in progress. The demand for electric vehicles is a big plus. So if you want an EV play, I don't need to explain to you again the potential of electric vehicles and how the stocks related to electric vehicles have run up, and this electric vehicle saga will be a positive for the stock and for the firm. Now if we look at the revenues, there is not much to be looked at. You can obviously see a very clear steady increase in revenues, especially from 17 to 18 there was a very good big increase, and the EPS is also very steadily increasing. So this is not the revenue and growth seems to be good. So over the last 5 years, revenue has grown at nearly 27% compared to the industry average of 5.79%. So you can see how clearly this has outperformed its industry competitors. And in the last 5 years, market share also increased from 0.47 to 1.21. So that has more than doubled in 5 years. Again, a very good positive sign. And over the 5 years, debt to equity ratio also has been just 11% compared to 42%. Again, the debt is also very less, again reducing the risk significantly for the company. Now if we look at the balance sheet, so the assets you can see have been increasing continuously, but then if you observe the last 2 years, what is happening? Your current assets, which is the cash and liquid assets, they have been increasing, but then the last 2 years they decreased. And what is happening to the fixed assets or the non-current assets? You can see this huge increase in non-current assets or your fixed assets. So again, this means company is making investments and is in the process of expansions, and this is, if it comes off, it would be very good for the company, obviously keeping again the EV play that this is in mind, and also the expansion would take place at a rather good rate. Now the next stock we have from the pharmaceutical sector, it's called Freon, and the company started operations from 1990s as just a contract manufacturers for big pharma companies, but currently contract manufacturing is only 2% of its total turnover, and the company has expanded production capacity by 30% in the last few years. So again, another very rapidly expanding company that we have here. And anti-diabetic products contribute nearly 25% of its revenues, and the number of Indians with diabetes is projected to reach 73.5 million in 2025. Now this is the big turning point for this company, and this is where all the most of the growth potential comes from. And another main factor to consider for huge growth potential is that it is targeting Africa, and which can also deliver very good growth. Again, this is a pharma company with huge growth potential in India as well as outside India. Now even if you look at revenues, not much to look at. Steady increase in revenues, steady increase in income, but you can see here the income has decreased. Why? This is just a one-off loss and not much to be bothered about. And the margins of this company is one small problem, and that need to be improved, because if you see the revenues are quite high, but if you see that compared to the net income, the margins are quite low. Margin is basically the percentage of this revenue the company is getting as its income. So the margins need to be drastically improved. And dividend per share has been 0.6. If you look at the price of the share, the price of the share is 425. So the dividend is pretty much insignificant only. So that's not something to rely upon. And if you look at the balance sheet, the current liabilities section, what is current liabilities? We saw the current assets is cash and liquid assets, and current liabilities basically means the liabilities or the debt or your loans which you need to be paying within a year or so. So these are just the short-term loans. Simply put, these are the short-term loans, and these current liabilities have been increasing. Now why are they increasing? Now if you see the capital expenditure, you can see that in the years before it had been 2.9 to 1.28, and they had a huge capital expenditure program in financial year 19. Now this huge capital expenditure, they need to get the cash from somewhere, right? Even if you see the incomes here are quite low, but then you see the capital expenditure is 16.4, and then this 16.4 investment, this also reflects here in the current liabilities increase. So they have obviously borrowed some money and then put it into capital expenditure. That is the simple logic of it. And free cash flow is basically what is the cash that is coming into the company or going out of the company, the net cash flow. So it was positive. A positive net cash flow is a very good sign for the company, but then obviously due to the capital expenditure programs, the net cash flow has gone down into the negatives as well. So if these capital expenditures pay off, then again we could see a very good growth in this company. So over the last 5 years, revenue has grown tremendously as 34% compared to industry average of 7% only. So again, almost 5%. Over the last 5 years, market share has increased by not much, 0.02 to 0.05, but obviously they are expanding still, and they hope to increase this maybe to 2 or 3% also. And over the last 5 years, debt to equity ratio, this is the main point I was stressing upon. Debt has been 164.88% compared to industry average of 45%. Now again, I just told you from the balance sheet. Again, here also it is quite evident that this company has taken over major debt for expansion, and if this pays off, it will be very good for the company, and if it doesn't, it might turn bad. So again, very, very risky investment, this one. So please don't go all in. Allot very small percentage of your portfolio maybe, so that even if you lose money on this, it doesn't affect you much. The next stock, Zelpmoc Design and Tech. It is in the IT sector. So what is this? It is focused on building next generation technology, especially in the artificial intelligence and machine learning space. So this is a unique business with no peer in India. So the other IT companies like your TCS or Infosys, they are not peers to this company. The closest peer which might come closest to this is maybe something like a Happiest Minds, but still even that is not a direct competition for this. And currently 85% of its revenue comes from the Indian market and the rest from the overseas market. So again, they are looking to increase their share in overseas markets, and that is their way to expand and grow. Consistent growth in quarterly numbers over each quarter is what the street is expecting from the company. So the company currently is sharing at pretty high valuations, and this is because the street is expecting, means the street is nothing but the investors. So the investors are expecting this growth to continue steadily quarter over quarter. So even if there is a small upset for 1 or 2 quarters in a row, it might affect the stock price negatively. And then if you look at the financials, obviously a very good increase in the revenues continuously. Net income has also recently turned positive. So obviously net income turning from negative to positive is a good sign. And EPS is also steadily increasing, and the free cash flow is negative for this company. So why is the free cash flow negative? So for IT companies, their main costs are not costs of commodities or the costs of raw products. They are the costs of the employees, the salaries, employee salaries. So obviously a negative cash flow means they are currently recruiting and hiring. And they are trying to expand by expanding their manforce and manpower. And here if we see the peer comparison, the PE ratio of this is currently at 100, which is very, very high compared to the other IT companies. But again, as I told you, these other IT companies are not direct peers of this company, and they are in the IT sector, yes, but they do different business. Now, if I look at the PE ratio of Happiest Minds, for example, so Happiest Minds PE ratio, you can see that this is trading at 83.58, which is much closer to its 100, right? So you can see that these companies which are into artificial intelligence and more innovation are obviously more risky, and people expect huge things from it, and obviously that is the reason why the PE ratio is so high. And over the last 5 years, debt to equity has been 14% versus industry average of 10%. So not much to be concerned about. It is average only. And over the last 5 years, current assets has been 500% compared to industry average of 273%. So current ratio means current assets divided by current liabilities. So the current assets, which means the company is currently rich in liquid assets and it can deploy any in times of crisis, and pledged promoter holdings is insignificant. This is a very positive sign for the company. Now the last stock, we look at Shilvalik Rasayan Limited, which is an agrochemical sector. So it is one of India's leading manufacturers of organophosphorus based insecticides and chemicals, established with a mission of producing effective and environment friendly chemicals for protection of plants. So this is the point to stress upon, and this is a very ethical company, and you can, maybe there will be some government policies in the future preventing more harmful chemicals and stuff. So in that case, this company would come out as the front runner, because this has already been producing environment friendly chemicals. So company has been doing very well when it comes to the agrochemical business, and for the last few years it has been exporting 50% of its production to various other countries. Now if I look at the revenues, there is a steady increase in revenues, which is a good sign. Steady increase in net income as well, again a good sign. The EPS has also been increasing, but in the last 3 years it decreased. Now what does this mean? The net income and revenue are increasing, but earnings per share is decreasing. So this basically means nothing but they have given some share bonuses and share stock splits basically, or stock bonuses, which will include the per share earnings. But as long as the net revenue and net income are increasing, this is nothing to be worried about. And the free cash flow, if you see, it was positive before, but it has turned negative in the recent years. And this negative is also not a small figure. It has turned hugely negative. So I went deeper into this to see why this was the case. Then I saw capital expenditure. You can see that 2.9, 15.1, 28.9 and 90.34. So these are huge capital expenditures from the company's side. And this is affecting the cash flows. That is why the cash flows have gone negative. All this cash is going into the capital expenditure, and also if you see the fixed assets column is also increasing. So obviously it is buying more machinery, buying factories, and buying more fixed assets, so in attempts to expand further. And total liabilities, if you see, the liabilities have not significantly increased much. So from 67 it's 78. Even though the fixed assets and capital expenditure have increased, the liabilities have not increased much. So this is again a very good sign, because you're not increasing your debt to expand, you're just using your profits and putting these into expansion for bigger profits, right? And over the last 5 years, market share has increased from 6.38% to almost 20%, which is 20% is a major chunk of the market. And over the last 5 years, debt to equity ratio has been 70% compared to industry average of 40%. So you can see that current liabilities were constant. Why? So they are not taking more loans. Why are they not taking more loans? Because their loan is already quite high at 70%. So obviously they're not taking more loans for this very reason, and they are expanding through their current income itself. And over the last 5 years, revenue has also grown at 35% compared to industry average of 77.85%, which is almost 5 times. So again, a very good company with a huge growth potential in it. So that's it for today, guys. Thank you very much, and please like, share and subscribe if you like the video, and you want, please comment down below and let us know if you want more videos of these type, and please share it with your friends if this helped you in any way. Thank you.